Can you just give us some size and scope, like how much they've grown over the last few years and how much money continues to come in?
Sure. So going back 10 years now, when I joined the team, I think we're at about $150 billion, and we're now over $700 billion. And what you're seeing is this trend moving to defined contribution. So more money is coming into defined contribution. This is how Americans are going to retire. So the demand is higher. Corporates are now engaging more. So think of auto enrollment, company matches. So it's driving a significant amount of flow into target date funds, LifePath specifically.
In a sense, though, I would imagine it's gotten a little more complicated. Also, we chatted about this on our planning call. The fact that, I'll never forget my first job. It was like, throw the 401k into the target date retirement fund, and then you just forget about it. And the asset mix changes as you get closer and closer to retirement. But then, over the last 12, 15 years, equities have just been on fire. Yeah. And had you overinvested or had been overexposed to bonds, you've really missed out. I'm curious how you think differently about the asset mix as people get closer to retirement versus maybe 10 or 15 years ago. Has that changed?
Definitely it's changed. The change in thinking we have is around what we describe as personal pensions. So what we've done very well with the industry, and this is exactly what you've seen, is that we've gotten people into the plans better. So this is auto enrollment. Auto escalation means that we're going to increase the savings rate over time. You have corporate matches, and they're invested in target date funds. These are professionally managed, diversified portfolios. It takes the guesswork out of it. So you do have lots of equities when you're young. The products that we oversee is 99% equities for young investors. You have a very long time horizon to compound. What we're seeing now, though, is that people that are approaching retirement need something more than stock and bond portfolios. And this is where personal pensions come in. So think of the DB plans. DB plans had a wider source of assets to choose from, whether it's private markets, different types of active management, and importantly, guaranteed income. That's the change that we're starting to see. So strategies we have like LifePath Paycheck, this is going to embed guaranteed income into the portfolio so somebody has an option of taking guaranteed income in retirement. If you give an individual money, large lump sum of money, and say, hey, you've got a large asset balance at 65, good luck. That's what we're doing right now in the industry. We've professionalized accumulation, but we need to take that money and show them how to convert it into spending in retirement.
Nothing is a given, though, and nothing's guaranteed. And we have certainly, if you think about the last, go back to the great financial crisis, like we have seen things in our lifetime where markets really come undone. And, all of us who were around during the GFC, I just remember thinking, okay, our financial system's going down. And there was a lot of moves to make sure that it did not. And that's the gold standard. We had COVID, the shutdown of the economy. Now, listen, we've bounced back tremendously. But how do you guys factor, like I said, nothing's a guarantee. So how do you figure that out?
Diversification. Simplest answer is, so this is where the bonds have come in. Bonds did very well during that time period. You're actually seeing a change now. This is one of the keys that we talk quite a bit about. Bonds have evolved to where they're not providing the level of diversification in the last couple of years that we've seen really since the 1980s, the early 1980s. They've not offered the same level of portfolio protection to equities. So we all owned fixed income because they offset your equity volatility. We're getting a lot more demand now across our book for alternatives. And this is where we talk about guaranteed income, private markets. And one thing we don't talk enough about are things like liquid alternatives. These are liquid funds.
Not everybody thinks alternatives in a retirement portfolio are a good idea, especially in the context of the challenges that we've seen in the private credit world of late. We've even had folks sitting right where you are saying it's a terrible idea to include this in retirement. These are products meant for sophisticated investors who understand what they're buying. And there's the concern that the stuff that will end up as an option isn't the best stuff. How would you respond to that?
There's a couple of parts. First of all, it's the structuring is the issue. It's not the access point. You can access private markets specifically in 401k plans today, but it's about how do you structure them. So
anyone can do it, or just accredited investors?
There's some stipulations of how it works, whether it's in the core menu or whether it's in the brokerage window. What we're talking about, though, is within the target date fund, where we are professional investors. We are Blackrock. We have Aladdin tools. We have the tools to build the right structures. What we've looked at, though, is leveling the playing field between what's offered in defined benefit plans and in target date funds. So defined benefit plans are running about 20% private markets today. Now, we're not.
This is a traditional pension for the few people who still have traditional pensions. Okay.
So they have those assets. So if you're in a pension plan, you have probably 20% of your portfolio in private markets. These are sophisticated portfolios. What we're advocating for is we want to be able to access those same investments. Now, we're not going to go from 0 to 20% overnight, but we need to expand the horizon of what we can do. Really, to your question about how do we evolve these portfolios differently, and this is the idea, again, of a personal pension.
Right.
How do we take those vehicles, put them into a target date fund? But this is the most important point, and I think this is missed. We have a benchmark. We have to manage to a benchmark. It's not a gross of fee benchmark. It's a net of fee benchmark that we have to hit. So we can't just bolt on private markets and hope things work out. It has to be about the outcome. And that's the change that you've seen in the markets now. We're much more focused on what is the outcome. And the outcome is getting to be more, how do I have certainty in retirement?
I mean, if it doesn't work, people aren't going to put money in there.
Absolutely.
Essentially, right? It's as simple as that. What is the retirement scene?
The good, the bad, and the ugly.
That people being confident about it, but not really being ready for it. Like, what is that point?
So the point we're making is the confidence is quite high. It's one of the highest we've seen in confidence. One of the reasons for this is markets are going up. So when markets are going up, and people's confidence is going to be directly linked to their account balance. So if I look at my account balance, if it's higher today than when I looked at it last time, my confidence is probably higher.
Guilty as charged. Anyway,
That's why you just never look. That's the trick.
There are times I don't look.
But the hope is with the target date fund, with professional management, we will rebalance this. We will adjust the portfolios. So if there is a drawdown, we can make changes. But the question about the retirement readiness, what we're really charting there is what's the gap between being confident today, but being able to have enough money to have certainty in retirement. And that's the gap that we're seeing. It's not a huge gap, but it does exist. And we want to just continue to encourage people to save more money if they can. But importantly, go ahead, sorry.
No, finish, please.
We want your money to work harder for you. And this is where we start talking about alternative investments. This is where we talk about guaranteed income. There's things that we can do to make these products more efficient. We've learned all this from the traditional pension plans. We want to be able to incorporate those in, because telling somebody they need to save 5% more is not always, it's not always a good conversation.
What I wanted to ask you, and I think I was looking at some retirement stuff, is that increasingly, you're going to need to think about your healthcare coverage, right? Sure, there's government and so on, but it can be a nightmare. Are you increasingly thinking about that in terms of what a person's going to need in retirement? Like, how does that factor in?
We refer to this phase as the retirement window. It's between the age of about 55 and 70. And this is when it really gets stressful for individuals. The numbers are pretty challenging. So about 2/3 of Americans say they want to work longer, and only about 1/3 of them end up working longer. When you dig into why, it's because their health, their spouse's health, or they lose their job. So that window, that 15-year window, is critical to understanding what choices do they have. How do we think about Social Security? How do we think about guaranteed income? And we've got to be able to position them in a way where they will have enough money in retirement, and what they're really looking for is that certainty.
So it's all of it.
How active are people, especially in times of volatility in markets, when it comes to the portfolios that they should, essentially all experts say, never touch it, don't change the allocation, set it and forget it, and just check on it every quarter?
The recent data shows that people are not particularly active in target date funds.
That's a good thing.
It is a good thing.
Because we get in our own way as humans.
Right.
Almost every study that we look at shows people in target date funds in general do better than people in the core menu, which is when they decide to do it themselves. The target date funds do the things that we know we're supposed to do. Diversification, asset allocation, rebalancing, that's what a target date fund does. Now, the one point that I would caution on, though, is that we've not seen a prolonged drawdown in the market for 16 or 17 years. And to me, it wasn't 08 that makes me nervous. It was we had 2000 to 2002, and then 7 years later, we hit 08.
I'm just going to, if you have the Bloomberg terminal, just go look at the chart of the NASDAQ during that time, the S&P 500 during that time. There were a lot of years where things just went sideways.
Yeah.
Well, do you feel like this AI era could be similar to that?
This is a much longer conversation than just whether the AI era is similar to that. It is. I think it is very different than that. I think what AI is doing is very different for a lot of different reasons. There's layers to the AI story. What is also different now is that we're investing differently today than we were 20 some years ago. So I started investing with my dad in the late 90s, buying IPOs on a payphone from my high school. So thinking about that versus teaching my sons about target date funds and talking about Trump accounts, we've gotten to this diversification point. We've gotten to a point about people actually own bonds now. They own alternatives. So I think it's a different investment market.
Okay.
It is more diversified.
It's also a market where people have to be in to plan for their retirement.
We only have 30 seconds left, but you mentioned Trump accounts. How does that fit into the retirement picture?
It's an access point. So it's about rewiring the entire retirement system. Trump accounts simply do what we all know is save earlier and let your money compound for longer. So if you can give somebody that is just born, somebody 5, 10 years old, more time to compound, you know the math as well as I do, that extra time of compounding is important. And I think the more Americans that invest in capital markets, American capital markets, the better we're going to become.